why do governments allow this to happen? Why do they let a financial product designed for financial relief turn into a debt spiral for retirees? And most importantly, needs to change. To understand why equity release operates the way it does, we have to look beyond individual lenders and straight into the policies that shape them. Because the truth is, governments have set the stage for this to happen. Whether through inaction, misaligned incentives, or deliberate policy choices, the system enables a cycle where homeowners, particularly retirees, end up shouldering the long-term consequences. Governments often justify equity release as a financial tool that helps older homeowners unlock the value of their homes in retirement. It reduces reliance on state pensions and allows people to fund their later years. On paper, it sounds beneficial, but in reality, it's a ticking time bomb. Here's why. First, regulation, or the lack thereof, is a massive issue. The Financial Conduct Authority, FCA, oversees equity release in the UK, and while it enforces some consumer protections, the current framework does not go far enough. Unlike traditional mortgages where affordability checks are stringent, equity release assessments are far looser. The assumption that because homeowners are older and not earning an income, they don't need the same level of scrutiny. But this leaves room for mis-selling, aggressive sales tactics, and a lack of transparency around long-term costs. Consider this. Many homeowners aren't clearly informed about the compounding nature of the interest. Equity release loans don't require monthly repayments, meaning the debt grows exponentially over time. What starts as a seemingly manageable loan quickly balloons, leaving families shocked when they realize how much of their estate will be lost. Governments could enforce stricter transparency laws, mandating lenders to illustrate projected debt growth in real terms. But they don't. And why? Because a financially strained aging population is less of a government liability if they're funding their own retirement. Then there's the issue of lender incentives. Many banks and financial institutions are more than willing to provide equity release products because they're extremely profitable. The risk to lenders is minimal, secured against property, with compounding interest working in their favour. Governments could cap interest rates on these products to prevent runaway debt accumulation. But instead, they allow lenders to set rates that, while technically competitive, often exceed the long-term affordability of the borrower. And here's the biggest problem. There's no structured exit strategy. Once you've signed up for equity release, unwinding it is incredibly difficult. Unlike a standard loan where refinancing or repayment options are accessible, equity release often comes with hefty early repayment charges, sometimes as high as 25% of the initial loan amount. Governments could regulate these penalties, ensuring they're fair and proportional. But they don't. Instead, retirees remain locked into agreements that diminish their wealth and limit their financial flexibility. So what needs to change? First, governments must enforce stricter consumer protections, requiring lenders to provide a full breakdown of long-term costs, including projections under different market conditions. A simple table of numbers isn't enough. Borrowers need clear, scenario-based illustrations of how much they or their heirs will owe over time. Second, there needs to be a re-evaluation of the affordability framework. Just because someone isn't making monthly repayments doesn't mean they shouldn't be assessed on their ability to absorb long-term financial consequences. Governments could mandate that equity release only be granted after homeowners receive independent financial advice, not just from advisors tied to lending institutions, but from FCA-regulated professionals with no vested interest in selling the product. And lastly, penalties for early repayment need reform. If a homeowner's financial situation changes and they want to exit equity release, they shouldn't be punished with exorbitant charges. Governments should introduce a standardized cap on these penalties, allowing for more flexibility without trapping retirees in financial contracts they no longer want. But here's the real question: will they? Because while homeowners are losing their wealth, financial institutions are making billions. And as long as governments continue to favour industry profits over consumer protection, the cycle will continue. That's why it's crucial to stay informed. The decisions you make today will determine your financial future, and knowing the risks is the first step to protecting your wealth. If this breakdown was eye-opening, you'll want to see what's next. Click the video on screen for the next deep dive, because the real dangers of equity release don't end here.